Okay, so what is today? December 22nd. Um, I just wanted to go through how I evaluate a stock. How I look at something and see if I want to buy it or not. So the stock was AVGO, which is going to be Broadcom. There's a lot of news about Broadcom. Good news. Good company. So I'm just going to evaluate this knowing nothing about them because I don't follow Broadcom. But the first thing that I want to do is look at their larger time frame, the 3 year 1 week, and I have these. It's the standard deviation channel. It draws a mean which I've colored gold. I colored it by hand. Um, so I change the middle line to gold. It's just personal preference how I like to view it, where green is buy and red is sell, and then the middle is just gold. So this is how I like to view the stock, where it's just lines across as a standard deviation channel, and I have them at two deviations and then 1.5, 1, and zero point 0.5. And so just observing this stock, Broadcom, it's very high. But we can see that when it started getting into AI development, it got a massive push. So if we were to ignore everything from January 2025, which is this year, this area here, it had a chart that followed this gold line pretty well, a little above, a little below, a little above, a little below, that you would want to be buying down here and then selling up here. And so you would accumulate shares down here and down here and then sell it up here. Now the chart has gotten a little wonky because it got so popular and it got so hyped up. But if you wanted to buy it, it would have been here. It would have been in April, which I believe this is the Trump tariff news announcements, where a lot of stocks look like this. So if you wanted to compare it to, say, like a Microsoft, it has the same thing. If you had Meta, it has the same thing. Google, it has the same thing. That sometimes it's difficult to buy something when you're looking retroactively at the stock because you say, oh man, I should have bought this here. But there was a lot of things you could have bought. And so I was buying something else. Same as like I would love to buy Nvidia. I never have. If there was a time to buy Nvidia, it was here, but I didn't buy it because I mean at that time I think I was buying AMD and Microsoft. So, I've never bought Nvidia. But if we were to look at AVGO, and wondering at what point we could buy this, this would have been the time. So if AVGO was something you liked, then you were sitting and you were waiting and you said, okay, now's the time right here. The problem with buying here at 150 back in April of the beginning of this year was that the chart didn't look like this at that time. It looked like everything prior. And everything prior didn't really say this was out of the ordinary. It actually kind of says, this isn't a great buy. It's basically exactly what the price is all the time anyway. 166, 157, what is this? 134. That this doesn't really look like a bargain at that time. Hindsight, it looks like a bargain now, but at that time, it didn't really appear to be a buy. And so for me, when I look at something for AVGO, it would honestly be something 2026 to 2027 when it has this year's worth of charts and then next year's worth of charts. And then out here somewhere is where I would start actually paying attention to it. So that's just my first look. My first look at AVGO is that it needs to develop some kind of chart that I can glean some information from, because right now it's just going through massive growth that doesn't tell me if it's a good buy or a bad buy. Why didn't that click? So I'm just going to drag these out and say that uh, sometime in 2026 I might be buying AVGO for under 420. If I get a price that's under $420 on AVGO in 2026, I would say that's a good price. Now you say, okay, well the price right now is 340. So if 340 and 420, obviously this is under 420, but this isn't a good price today. 340 in, oh, January of 2026, 12 months from now, is an incredible price. 340 today is not the same price. So for me, when I evaluate this, I look at it and I say, if I was to buy 100 shares of this, is it worth it for me to buy 100 shares here for it to not even be worth $340 until January of next year? I don't want to tie up 100 shares of AVGO for 12 months before then I start feeling good about the price and start feeling like I'm going to make money off of it. So if I waited for this to come down, or I waited for, this to come down to 240, or if I waited until next year, and once it has like a more progressive chart and I can see more of what it is doing, and then I get a price of 340, that's when I want to buy it. I don't want to tie up funds of my money into this for 12 months when I won't even make 10, 20, 30% until 18 months from now off of this price. And so just for me, when I look at AVGO, that's initially what I look at, is where is the price relative to its history. Now it might do something like this and just run. It might just absolutely disappear. So if I take what it's done this previous year and I extend it out, then it starts to look more like this, where this was a make-believe no, right here, so we'll remove that one. So it starts to look more like that. If I shrink this down, that means that, let me extend this out to the right. So if this continues to run the way that it's been building for the previous year, then 320 today is nothing, because at the end of next year it's going to be worth $586. So that's when you have to have some kind of conviction in this company, and I don't know anything about it. So I don't have that kind of conviction in Broadcom, because I don't know what this company does or what their importance is to the market, what their growth prospects are. I don't really know anything about it, but its trajectory based on its previous year and all of the hype and the growth of what it's becoming and growing into says that by this time next year it'll be a $600 stock. And so then I could start looking at it saying 340 is a really good price for Broadcom, because next year it's going to be 600. That is almost 200% return. You almost double, probably more like 1.75 or something. I could break out the calculator and do the math, but I'm just not going to. But from 340 to 600 is a good return over a year. Like, that's a great return over a year. And then if we looked at the yearly chart is low. It's below the gold, and it's here in the green. So if Broadcom was a company that somebody was interested in, they could certainly buy it. But that is if Broadcom is something that you like. Where it's not something I like. I have no opinion on Broadcom at all. This is my first look at the company. So, based on that, I have no opinion on it. It doesn't really matter to me at all what Broadcom does. But if somebody picked this out the way that I picked out Tesla and said, this is the one, or the way that I had picked out AMD and said, this is the one, where this is the one that I like, it's a company that I can get behind and that I can understand and know exactly what is going on with them, and then I see a price like this, then I jump all over it. Now, that's not for me to determine, because I am not like emotionally committed to Broadcom. I really like Tesla. I really like AMD. Broadcom doesn't mean anything to me, so it's not that I would say don't buy it. It's that I would say I'm not buying it because I'm not interested in it. It has no value to me. But it does have the prospect, if it continues this kind of growth potential that it's had over the last year, that it'll be a $600 company at the end of 2026. And so then if that return from 340 up to 600 is something that interests you, which it should, then yeah, go ahead and buy it. and then this is a good price. It's below the it's average that it traditionally trades at for the previous year. It's half a standard deviation away from the mean. That you could start buying this, and you could start buying it for, let's just draw this line out here. And today that price is 340. So if if somebody wanted to buy this, that price is actually 339.86 if you wanted to be precise. But that's just today. So then what I typically do is I draw a line here and I say, I mean, just give me anything under here. I mean, it's really just a make believe line, but anything under there. So anything under 339.82, just call it 340, where then I start buying any AVGO that's under 340 for the next several weeks so that I can acquire a handful of shares. However many I get on Friday is however many I get on Friday. And then I would buy every week that it's under 340, just simply because I have conviction in this company and that it would grow to 600. So, that's how I evaluate based on the chart, is that I have these standard deviation lines. When it gets to something that is low and is cheap, relative to its normal expected average here, and that this is high and this is low, then I just start buying it. And so then I draw an arbitrary line right here at 340 and say everything under 340 I'm willing to buy. And I'm willing to buy everything under 340 for however many weeks it stays under 340. But when it breaks up above 340, then I just hold. And I hold until until I decide that the price is sellable. So if I said, give me a calculator, and I want 340 and I want 30%, 442. So where is 442 on the chart? I'm going to make this and 442, we'll just call it right there, which is this one standard deviation on the high end. And it realistically, it never gets there. It never gets that high. So we're probably going to have to look at this, which is a half a standard deviation away. Just based on its history, it never really gets that high. That we're going to have to take this line instead. And so that means that short term, if you started buying this today, then sometime February 20th, it has a reasonable chance to get to 440. And then anytime after that. So then, as like a trade plan idea, today is December 22nd, and this was, call it February 22nd. It's 2 months. It's 8 weeks. And so then you put together an 8-week buying plan that says, I am going to buy on Friday for 8 weeks in a row, with the expectation that after February 22nd, it has a reasonable chance to be above 440. And when it gets there, I'm going to sell it because it's now high in the chart. It's above its standard deviation by a half a standard deviation, and historically it sells off when it gets there. It gets up there and then it sells off, and then it tracks its mean, comes back up, sells off, tracks its mean, comes up, sells off, comes up, sells off, and now we're down here where I want to buy it. And so, I mean, that's just a very simple outlook on how I evaluate any given company, is that I want to buy it for cheap and I want to sell it for high. So I want to buy it low and I want to sell it high. And I want to buy this for 8 weeks with the expectation that it could reasonably reach $440 by February 22nd, which gives me 8 weeks of buying. And I mean, that's the breakdown of how I evaluate something. If then we were to look at like the moving average, convergence, divergence, you can see that it comes down and it crosses over. Generally speaking, when it crosses over, it's starting to switch direction. But sometimes they call these false breakouts because it broke out and then it didn't. And it curled back down and it broke out, but then it didn't. And then it finally did break out and start climbing reflected on the chart. So I don't really trade off of moving averages and where the lines cross over because there's too many failures. Whereas if I just buy it when it's low, or when I comfortably believe that it's low, like say you bought this, which I think is that April of the Trump tariff news, you could have just bought this every week down here because it's more than a half a standard deviation away, which historically it doesn't spend a lot of time more than a half a deviation away, and the chart is traveling upwards. These lines are angled in an upwards direction. So over time, this stock does gain value. That no matter where you buy it, it's going to gain more value than where you bought it at some point because the chart travels upwards. So you can comfortably buy this company wherever you want to. I just want a good price on it. And so the moment it breaks down to more than a half a standard deviation away, just on this company, some other ones get all the way down to 2 or all the way down to 1 or 1.5, but this one, it seems to want to track somewhere between a half a standard deviation above and a half a standard deviation below. That if I get anything below a half a standard deviation, I want to buy it. And so that is true here back in April, and now it's true today. That if the company was interesting to you, you could buy it here. Now, back in November 24th, it was this same price, but this price at 340 is not the same as this price at 340 because the stock travels upwards, the chart is upwards, it's in a grow potential upwards direction. That 340 a month later is a far, far better deal than 340 a month ago. So you could start buying it here. You buy it for 8 weeks or at least an 8-week plan. And when it gets back up above 340, you just stop buying it. You stop buying it, you take it all the way up to 440, you make 30%, and you drop it. Then out here in March, or out here in February, when you start selling it because it's above your price target and because there's something else to buy. If there's nothing else to buy, then you can just let it sit. But when, say, like Nvidia or Microsoft or Meta or Amazon or something else is now down here, a half a standard deviation or a deviation away, or wherever it is, you see something that's low and you say, okay, now I need to start freeing up funds. Where are those funds going to come from? Is it going to come from this Netflix here? No, because you've been buying this. You could sell Netflix when it's up here, but you can't sell Netflix. Imagine this is February. You can't sell your Netflix because you've got it for this cheap price. Those funds come from AVGO. AVGO. So when it's up here at 440 and you say, okay, now Amazon is down and I want to start buying Amazon, and AVGO is above 440, it's above my price target, that I can start trimming off my AVGO and cycling it into Amazon because Amazon's low. And so that's when I start to sell something. But I mean, that's how I evaluate a stock. That's how I perceive it and look at it. Now, when I use the moving averages and the Bollinger Bands is when I'm just sitting and waiting for something. I know that right now I'm buying Meta and I'm buying Netflix. Like, I already know that. It's down here and I'm buying it. Meta is down here and I'm buying it. Like, it's just that simple. It's down here and I'm buying it because of its growth and its upwards direction in the chart, and that Meta makes money and they continue to grow year over year. I'm willing to buy it down here to sell it up here. But I already know that I'm buying Meta, and I already know that I'm buying Netflix. And if I was to continue to buy these for the next, I don't know, 8 weeks, like same as AVGO, I was to buy these for the next 8 weeks, where am I going to go 8 weeks from now when these are high and I can't buy Netflix and I can't buy Meta anymore? Then what am I going to buy? And so that's when I start using the Bollinger Bands and the moving averages, where Microsoft wanted to get down and pay some of this out, and it did. Now it's starting to build up, and Microsoft is a really good buy right now. So you could buy this, and let me zoom that out a little bit. When the moving averages exceed the Bollinger Bands, which is one standard deviation away from the mean, then I believe it's going to come up here and start climbing again. So this kind of tells me when, and the when for Microsoft is coming very soon. That you could have bought all of this Microsoft knowing that it's going to climb, and when you say when is it going to climb, the when is right here, and it's going to happen soon. So I can't buy Microsoft in probably 8 weeks. Oh, where is Nvidia? Oh, Nvidia's. Let's get a closer look. It's not quite showing up as a when that it wants to climb yet, and I believe it still has the 3-year 1 week drop here. So I'm still expecting Nvidia to drop. That if I bought AVGO today and bought it for the next 8 weeks, then when AVGO is up here somewhere, potentially Nvidia is going to be down here. And so then I start cycling out of AVGO and into Nvidia, because Nvidia will be down here. And then I look at it and say, well, that's a really good buy for Nvidia. I'd really like to buy that at sub 160, or as time progresses, it's this line. Anytime it gets under this line, which has been, I've been calling it 160, but I mean, today it's 160, 134. In what is that, 6 months? In 6 months it'll be 187.29. The price that I'm willing to pay for Nvidia will keep going up, but I still want it to be under that line at the time that I buy it. And so today, for me, that price is Nvidia 160. If AVGO is up here somewhere in 2 months and Nvidia is down here somewhere in 2 months, then I start cycling out of AVGO and start cycling into Nvidia. And so that's how I evaluate a company and decide if I want to buy it or not, and then how do I navigate and move from company to company, where right now I'm buying Meta and I'm buying Netflix. In a couple of weeks, I expect to be buying Nvidia, and I still, I've been expecting it for many weeks, for let's say 4 weeks or 8 weeks. I've been expecting to buy Nvidia, and it just keeps lingering here, that if it never gets down here, it's still fine, because I've just been buying Meta and Netflix. But I really would like to buy this, and I really would like to buy Microsoft. But if the timing's not right for it, then the timing's not right for it. But for AVGO, if it gets down into here, or if you believe this trajectory that it's been on for the previous year, you could buy it under 340 with the expectation to sell it at, what was that, 440 2 or 3 months from now. And somewhere between that 2-month and 3-month mark, you might get that pop that takes it up to 440. And so that's what you would be waiting on. But then at the time that it reaches that 440, you say, okay, now if I sell this, that's great, I made money. But then where does that money go? And so then you have to find which one's low and move the money into that. And so that's really how I look at it. Now, if I was to pull up Finviz. No, I don't want that. I want that. Yes. Okay, so... No, there we go. So this is Finviz, and given that I don't know anything about AVGO, let's take a look at it. It has a PE of 70, which I'm not a fan of. That sounds very high to me, given that I don't know anything about this company. It has a PE of 70, but it has a forward PE, which is the expectation of next year, of 24. And I can get behind this 24 number. This is very high, but what they're saying is that next year they're going to quadruple who they are as a company. And, I can't say anything bad about thinking that you're going to quadruple who you are as a company, so it's not a bad thing. Looks like they pay a dividend, which is interesting. Oh, it's not enough to care. 0.77, so it's not even enough to care that if you started buying this and it wasn't moving, at least you still get paid. But it's not enough to care, so it doesn't really matter. But yeah, forward PE looks good, and that means that their growth expectation is obviously 400% next year. What is their price target? 461, which kind of aligns with my price target of 440. It's not that far off. So, I can't really say anything bad about it. Generally speaking, the price targets are 12 months out, and so my price target, what was it? I think it was like 600. Was it? Yeah, 591. So we go back to FinViz. They have a high price target, December 2026, of 531. The average is 461. Um, Usually, what that means is that if we took like this gold line and drew it out, that's 406. Where was the yearly at? Yeah, that one. Yeah, it's kind of hard to evaluate because of its massive growth that it had over this previous year. But nobody, no, none of like the fancy analysts are saying that it's going to reach 600. Um, they wanted, well, basically right there 423 by the end of the year, which is still upside. It means that regardless of if you bought it regardless if you bought it today or not, um, everybody still thinks it's going to get to 461. And so you're going to make about 40% on AVGO next year if you were forced to hold it for 12 months. Where if you bought it and you bought all of this and it didn't make the move that I expected it to make, everybody else still expects it to reach this number. Instead of by February, they expect it to reach it by December. But 40% return in a year isn't that bad. So, if it did reach 461 by December of next year, that's not that bad. But I would also expect it to not just track straight across and be the most boring, lazy, slow move up, that it will have these peaks and it will have these valleys, that at some point before December, you'll get that peak at 460 or my number 440. You'll get that peak early, and so you get your 40% early and you just sell it, take the money, and run. That at some point before December, you're very likely to get that 440 number. But analysts are saying 461 to 539, 372 on the low end. Oh, what was their earnings per share this year? They had a growth of almost 50%, a growth next year of 40%, and over the next 5 years, 35%. So they are expecting to just continue to grow. So you could expect this chart to continue to travel upwards because they're just going to continue to be a better company next year than they were this year. If we're at 340 this year and they're expected to grow, what was it? 40%, then 40% next year is that 440 number, and then 40% of that the next year after that. Where'd my calculator go? 440 times 1.4. They're expected to be $616 in 2027, and let's say 616 times 1.35, I think it was, $831 in 2028. So that kind of outlook says no matter where I buy this, it's going to pay me pretty good in the future, regardless of the price. If I bought it at all-time highs right here at 414, it doesn't really matter because I can bag hold this for 3 years and double my money. If I bought 100 shares of this or 200, 500, it doesn't really matter. But if I bought 100 shares of this, then it'll be worth twice as much in 2028 as I paid for it today, is kind of what their projections are saying. And this isn't opinions and ideas of reading the chart. This is their fundamental earnings. When they announce how much money they made officially, not opinions but facts. They say every 3 months we have our earnings. We tell you exactly what we did. We tell you exactly how much revenue we had, how much we made off of it, and where we expect to go from there. These are the numbers. And so if it just keeps tracking as it's been doing, then it should be $831 in 2028 or $616 in 2027, or what was it, $460 in 2026, that then you could say, okay, I could just buy this whenever I want. And so that's how you, well, that's not really how you evaluate it from the financial numbers side, but it's a quick and dirty way to look at it and say, you know, everybody else is super super smart about this and they keep buying it, it keeps moving up, so I can believe that if there was something catastrophically wrong about the way that I'm looking at it, then this wouldn't be traveling upwards, because the people who are smarter than me that do this professionally and can break down all of their financials have already looked at it and said, yeah, we'll just keep buying this. We'll just keep having this move upwards. And so I look at it and say, stock is moving upwards. Okay, good. Stock is expected to have a forward PE that's pretty reasonable and continue to grow year over year. Okay, good. Somebody else already dug into these numbers. They already did all of this, and I don't need to be that one smartest person in the world who finds the secret wizardy stuff of their, their books and their financials and say, "Ooh, this is, the secret wizard of reading accountant stuff." I don't need to do that. I really can just look at the chart and say, "Oh, chart go up, I buy." But that's how I evaluate it. And that's kind of it. So if you have any questions, just let me know.